In the last 1 week, there have been two important key updates in relation to Reserve Bank of India for our country. The first one is that RBI has announced its fifth bi-monthly monetary policy of financial year 2025. And the second one is that after ending months of suspense, Government of India has appointed the Revenue Secretary Sanjay Malhotra as the new Governor of Reserve Bank of India.
New RBI Governor, the government has appointed Revenue Secretary Sanjay Malhotra as the next Reserve Bank Governor. Malhotra, a 1990 batch Rajasthan cadre IAS officer, will now replace Shakti Kanta Das.
The Governor of the Reserve Bank of India, Shakti Kanta Das, his tenure as RBI chief ends next week, but the government has been silent about his future. Will they give him an extension or will they replace him?
Replacing Shakti Kanta Das ji. Now, keeping these two updates aside, focusing on the first one, the 6-member Monetary Policy Committee, led by the RBI Governor Shaktikant Das, has decided by a 4:2 majority to keep the benchmark repo rate unchanged at 6.5% for the 11th straight meeting and maintain the monetary policy stance as a neutral stance. However, the rate-setting panel has slashed the cash reserve ratio by 50 basis points to 4% from the earlier 4.5%. Now, this reduction in CRR will be implemented in two phases of 25 basis points each on December 14th and December 28th of this particular year. And this move, it aims to inject liquidity into the banking system of our country and enhance the bank's lending capacity. So, in today's discussion, we'll be trying to understand what will be the implication of this monetary policy of the RBI and how it will impact the Indian economy. Hello, my name is Preetpal Singh and you're watching Perspective. Now, we all know that RBI is the central bank of our country, established on 1st of April 1935, based on the RBI Act of 1934. And this RBI was set up on the basis of Hilton Young Committee recommendation, formerly known as the Royal Committee on Indian Currency and Finance of 1926. Now, the main role of Reserve Bank of India is to come up with and to implement the monetary policy of a particular country. And in India's case, India's monetary policy. See, if we see from economic lens, there are two economic policies important for every country and for India as well. That is monetary policy and fiscal policy. Now, monetary policy is the economic policy of Reserve Bank of India. And fiscal policy is the economic policy of the government of the country, that is Government of India. Now, fiscal policy of the government is reflected in the budget and monetary policy of the RBI is reflected in this bi-monthly monetary policy update given by the RBI. Now, as many of you would already know, that monetary policy constitutes of two parts or two tools. One is quantitative tools and another is qualitative tools. And amongst the two, quantitative tools are the most important. Now, under the quantitative tools, there are three important measures which can be taken by the RBI. First is in relation to the rates, which involves primarily repo rate. Second is in relation to ratios, primarily involving two ratios, that is cash reserve ratio and statutory liquidity ratio. And third is in relation to open market operations, which involves buying or selling of government securities. Now, let us first focus on the ratios, that is CRR and SLR, and then we'll be able to understand that RBI, by slashing the CRR to 50 basis points, how it will be impacting the whole economy. So, coming to the ratios, that is CRR. The full form is cash reserve ratio. That means RBI says or RBI tells the commercial banks of our country that certain percentage of the total deposits which you have needs to be maintained as reserves with the RBI. So, for example, there is a bank, let's say HDFC Bank. Now, HDFC Bank is having total deposits. Technically, we call it as net demand and time liability. Now, the question might be, why the term liability? See, because deposits for the commercial banks are a form of a liability for them, because someone else is depositing money to the commercial bank and commercial bank are indebted to pay that money to the other person. So, it is a liability of the commercial bank to pay that money back to the depositor. That is why the deposits to the commercial banks is the liability. And the loans which the commercial banks give, it is the asset of the commercial banks. Now, coming to this point, that the net demand and time liability, that means the total deposits which are made by the public to a commercial bank, the RBI says that, let's say HDFC Bank is having 100 crore of net demand time liability. That is, cumulatively, people have deposited 100 crore to HDFC Bank. Now, RBI says that you can't lend, or HDFC Bank can't lend whole of this 100 crore to the public. Otherwise, what would bank have done? If they get 100 crore as deposits, they would lend 100 crore to the public to earn profits. But RBI says you can't do this. Commercial banks ask why. RBI says that in the case of emergency, what if you require certain funds? Which is why RBI came up with the provision of keeping certain reserves. So RBI says to the commercial banks that 4.5% of the net demand and time liabilities which you have, that is of that 100 crore, 4.5% you should keep as reserves with RBI itself. So you keep 4.5% of 100 crore as reserves with the RBI. That is, HDFC Bank needs to maintain 4.5 crore reserves with the Reserve Bank of India. And this reserve is to be used in the case of certain emergencies. And one very important thing to note here is that since it is being used as a safety measure to protect the commercial banks and to make the commercial banking system of our country secure, the RBI would not pay any interest to the commercial banks on the reserves maintained by them with the RBI. So there will be no interest given by the RBI in this CRR case. And earlier, before this monetary policy announcement, the CRR was 4.5%. And now the CRR is 4%. So basically, RBI has told commercial banks that earlier, out of 100 crore, if you had to keep 4.5 crore as reserve with RBI, now you just have to keep 4 crores as reserves. Now you think of this percentage wise in hundreds and thousands of crores. Now from that lens, it would make a lot of sense that now RBI is telling the commercial banks that you have to keep lesser reserves with me. Earlier you were keeping 4.5% of net demand and time liability. Now you keep 4% of net demand and time liability. That's all. Now with this, what is really happening? RBI is telling the commercial banks that you keep lesser reserves. Now, if commercial banks keep lesser reserves, where will they use the extra money? They will use that extra money, which earlier they were keeping as reserves. Now it is free to them. Now they will use that money to lend it to the public. So it will enhance and improve liquidity in the country, liquidity in the banking system. It will improve the lending capacity of the commercial banks, and commercial banks should be willing and able to give more loans than what they were willing and able to give before. So which is why slashing down the CRR will have a significant impact in the loan giving capacity of the commercial banks of our country. Now, one is CRR. One more thing which I told you was in relation to SLR, that is statutory liquidity ratio. Now the RBI said that this 4% reserve which you are keeping with RBI, which commercial banks or HDFC Bank kept with RBI, that is not sufficient. RBI said, and that is not all. Of that 100 crore, 18% you keep as reserves with yourself also. That means 4% is to be kept as reserves with the RBI. And further 18% of the 100 crore needs to be kept as reserves with the commercial banks themselves. And in what form? In the form of liquid assets. And what form of liquid assets? Either it can be cash, or it can be gold, or it can be government securities. In these three securities, in these three liquid assets, the commercial banks are obliged to maintain reserves with themselves. And at what percentage? At 18% of net demand and time liability. And this additional reserve, which the commercial banks have to keep with themselves, is what we call as statutory liquidity ratio. And in our country, currently the SLR is 18%. CRR earlier was 4.5%, now it is 4%. And if we combine the CRR and SLR, combined we call it as required reserves. That means reserves which are required to be maintained by the commercial banks mandatorily if they have to do banking business in India. Now SLR also works the same way. Just take a situation where RBI comes and says that the reserves which the commercial banks are maintaining in total, that is the required reserves. Let's say the required reserves are now to be maintained at a lesser percentage. What will happen? If required reserves are less, that means the lending capacity or the lending ability of the banks increases. If 100 crore is there and the commercial banks, they have to maintain required reserve of 22.5%, or how much they are able to give loan out of that 100 crore. 100 crore minus 22.5 crore. What is left? 77.5 crores. So 77.5 crores the banks would be able to lend to the public. Now, what if this required reserve is reduced? From 22.5%, it is reduced to 22%. In that case, the banks would be able to lend 78 crores. Earlier, they were able to lend 77.5 crores. Now, they would be able to lend 78 crores. That means a reduction of the reserve requirement, reduction of CRR or reduction of SLR increases the lending capacity, increases the lending ability, and further increases the loan capacity of the whole country, loan capacity of the banking system of the country, and people get more loans. So there are several ways in which this reduction of cash reserve ratio will help the country or will impact the whole economy. First is it will improve the lending capacity. So lending capacity will be more. Second is it will lower the borrowing cost. Third is better net interest margins would be there. Fourth is it will increase the profitability of the commercial banks. Fifth is it will support more loan growth. So retail, MSME and corporate credit demand, it can be met effectively, focusing more on increasing the loan growth. Sixth is that it can improve the liquidity position of the banks, and also it will lead to stronger balance sheets. So with increased credit demand and loan distribution, banks can definitely improve their asset quality and their financial health if they lend judiciously. And this recent 50 basis point cut of the CRR by the RBI, it will free up around 1.16 lakh crores in liquidity for the banking system. So now you know, just by reducing the CRR from 4.5% to 4%, it will unleash up to 1.16 lakh crores to the banking system of the country, and it will boost the bank's lending capacity and the lending resources. Now, there were a few more decisions which were taken in this Monetary Policy Committee meeting. One was this reduction of CRR. Another was that repo rate, it remains unchanged at 6.5%. Now, question is, what is repo rate? Now, simply speaking, repo rate is the rate at which central bank of a country lends money to the commercial banks of that particular country. And it is done for a short period against the government securities. Now, that is the second change. There is third change also. This Monetary Policy Committee, they have revised the GDP growth forecast for our country as well. The GDP growth forecast for the financial year 2025 was revised down from earlier 7.2% to 6.6% due to the economic slowdown in the second quarter, which registered a GDP growth rate of 5.4%. Which is why RBI has also reduced their growth forecast for the country. Also, the fourth key decision is to revise the inflation forecast for the financial year 2025. From earlier 4.5%, now the inflation forecast is 4.8% due to the rising consumer price inflation. And this has reached a 14-month high, up to 6.21% in October 2024. That means it has surpassed the inflation target of 4% plus minus 2%. So these were the key policy announcements which were made by the Monetary Policy Committee in the start of this particular December. Now, the last question which we'll address here is that what is this Monetary Policy Committee? Now, in 2016, our country came up with a new framework. That is Monetary Policy Committee framework, where a new Monetary Policy Committee, a 6-member Monetary Policy Committee was set up. And the main target was to have a particular inflation targeting framework in the country. So it was set up under Section 45ZB of the amended RBI Act of 1934. And it established a 6-member MPC Monetary Policy Committee to manage monetary policy and inflation management in the country. The main function of it was to set up the benchmark repo rate, that is policy rate, to keep inflation within the government's target range of 2% to 6%, that is 4% plus minus 2%. And the composition of Monetary Policy Committee is very simple. The ex officio chairperson is the RBI Governor. The RBI Deputy Governor in charge of monetary policy is also a member. The third member is one official nominated by the RBI board, and other 3 nominees are nominated by the central government. So there are in total 6 members of this Monetary Policy Committee, and out of the 6 members, quorum constitutes of 4 members, without which a meeting or a decision cannot be taken. And this Monetary Policy Committee, bi-monthly they come up with a monetary policy review. So this recent Monetary Policy Committee decisions, it showcases one very simple thing, that the role currently of this monetary policy or the RBI is to boost liquidity and inject liquidity in the banking system, in the financial system of our country. And the reason is simple. Our country is currently definitely on a path to become $5 trillion economy in few years and eventually become a $10 trillion economy. And for that, we would need debt. For that, we would need better loans, good quality loans. If loans are given to the people would be using those loans, companies would be using those loans for capital formation. And if capital formation takes place, combined with the multiplier effect, our per capita income of the country, alongside the GDP of the country and the economic growth of the country, it will surpass the highest levels which we have already seen. Which is why these steps taken by the Monetary Policy Committee, they are appreciable, and the neutral stance which they have kept, it is very important for bolstering the economic growth and economic development in our country. Now, what next this Monetary Policy Committee comes up with the decisions, it is for us to see. Till then, I hope you gained a new perspective from these changes and how it will impact the Indian economy. What are your views regarding the slashing of CRR and the other decisions taken by the Monetary Policy Committee? Please let me know in the comment section. I'll be very happy to read them. All the very best and have a beautiful day. Thank you.